Great to have you with us. So, one of the big Canadian stories today is better than expected economic growth in the first quarter. The GDP numbers for Q1 coming in at 2.2% growth, topping expectations. But a lot of people are looking at that with a grain of salt. The idea that people might have been busy when it comes to economic activity ahead of any tariff realities. And so what is going to happen with the Canadian economy going forward? Now, this is going to be a balancing act for the Bank of Canada as well, because they have an interest rate decision next week. So let's get some insight and analysis now from Randall Bartlett, who is Deputy Chief Economist at Desjardins. Randall, nice to have you with us. When you look at the Canadian economy and you look at the Q1 numbers, but you also look at what people are anticipating for the rest of the year, what do things look like to you?
Yeah, I mean, just unpacking the Q1 numbers, there's a lot of volatility under the hood of this release. When we look at the trade data, certainly a positive contribution from trade, but I think economists generally were expecting that. And what you see is that there was a lot of importing and exporting going on with the U.S. ahead of the tariffs. And so certainly that led to a lot more volatility on the trade side of things than we'd normally see. But when we look at what's happening with domestic demand, we actually saw that's consumption, that's investment, that's government spending. We actually saw it contract in the quarter. And so certainly we're seeing a lot of weakness on the domestic side of the economy outside of what's happening in trade. And so we think Bank of Canada is really going to look to what's happening domestically. We've seen a lot of weakness in labor market reports recently, both in terms of the labor force survey and the establishment survey. And so we think that combined with the weakness that the Bank of Canada is seeing in its own surveys, whether it's of businesses or consumers, we think it's all going to add up to a 25 basis point rate cut at next Wednesday's meeting. Okay,
so that's that puts you, as you know, in the minority when it comes to the call for next week. However, it's a good conversation to be having, because even though the majority of economists are not making the same call, you've got plenty of economists who are anticipating that there is still a need for rate cuts in Canada, whether it's later this year or moving into next year. If the bank does cut by 25 basis points, as you predict next week, what do you think their language is going to sound like? Because I guess sort of the other side of it is some people say, well, you know, if you look at some of the readings of inflation that the bank likes to zero in on, maybe there is a leg they can stand on for holding off on rate cuts. So what would be the language you'll be watching for?
Yeah, the language we'll be watching for is what the bank is seeing in the soft data, which tends to lead the hard economic data, which we get, you know, with a lag of a couple of months often. We think we're going to be looking to consumer expectations and what's happening on that side, both in terms of where the economy is going, but also in terms of where inflation's going. Now that we've had energy prices come down with the scrapping of the consumer carbon tax federally, so we think that's going to be part of the discussion. And additionally, you know, we think the Bank of Canada is really going to be looking at what's happening in terms of total inflation, as opposed to all of the myriad of core measures that it also looks at. So while we have seen a rise in core inflation in the most recent couple of months, when we unpack the data, we think it's really a lot of it's an aberration, that we're not going to see a sustained rise in core inflation going forward. And instead, what we're going to see is that when we look at headline, that reduction in the consumer carbon tax is really weighed on inflation in the near term, and we think that's going to be sustained over the next year. And we think that gives the Bank of Canada the room to continue easing monetary policy as we see economic conditions weakening around us in the most recent data.
Okay, so room to ease is one conversation, room to spend is another, and here we are in an environment where we don't quite know what's going to happen for Canada. We do have a new Liberal government that seems committed to some continued sizable spending. You and the Desjardins team have been sort of charting out just how much we could be seeing. And in the moment, everyone is always sort of willing to try to fight through the storm. But we speak so much about the deficit tensions in the U.S. Should we be talking about deficit tensions in Canada as well?
Absolutely, we should be talking about deficit tensions in Canada. When we look at the Liberal Party of Canada election platform, the plan was to run deficits which on average are $20 billion a year larger than what the previous administration projected back in December. And, there's a good chance that those are going to be even larger as we see the economy weaken. And also we get strains from things like demands for higher defense spending, potentially up from 2% of GDP in the plan to 3.5 to 5% of GDP. So that is going to increase deficit substantially and push the debt to GDP ratio consistently higher across our projection. And when we look at what the government's put in the window in terms of directing, allowing Canadians to know where the debt profile is going to be going, they haven't published a budget yet or any sort of material fiscal documents that give us a sense of direction either to Canadians or to markets. And so I think it is going to be an increasing part of the conversation in Canada, particularly as we see sovereign yields at the long end of the curve continue to move higher.
All right. Well, good food for thought there, Randall, and obviously part of a longer-term story that we have to continue to watch, but we'll be watching very closely that Bank of Canada decision next week as well. Appreciate the insight. Randall Bartlett, Deputy Chief Economist at Desjardins, joined